Okay, good evening to all of y'all. And this is, I think, last discussion which we have to do, which is step 3, which is the pre-scene discussion. And before starting this discussion, Lamai, which I really need to tell something, maybe at 8 p.m. There is a power cut, then please bear with me. Give me at that time if it happened, because it's the time, it's between 8 p.m. to 8:20. Then therefore, please bear with me. Give me in that time 2-3 minutes, then I will fix with the data and come back to y'all. If something happen, but for it's only for that time, then give me that, bear with me on that time, then I will again join if that happen within 8 to 8:30 period. It's a one of the message which I really need to provide. And let me come to this. I think all of y'all can see the PowerPoint presentation. I will show it in this manner because I'm not going to the full screen, because I need to type, I need to highlight, I need to do something in the PPT. Then, okay, then let me start the session. Then this is for July 2022 examination. Your company is one of the, based on the provided information, your company is one of the, which is, okay, yeah. Definitely, this session, before starting this, I know all of us suffering from the power cut. Then don't worry, this will be recorded and it will be published for y'all. This is for y'all. Then all the nitty-gritties, all the PowerPoint presentation I will share. Then therefore, don't worry, don't have the hesitations. Then all relevant documents will be provided to y'all. Okay, now, with the clear mind, with the fresh mind, please start. Then this is your company, which is CAPL. Now, this is one of the real life example which we can have, I think, by looking at this. You all know what's the company. In the same, in a similar kind of a company is there for us. Then therefore, this company, if I have taken, it's very close to our life in the real life example. Then you have that particular mindset, and we will start the session. And again, this is your pre-scene, which issued. Then this is there. What I'm doing from the PDF, if relevant, I'm taking some factors also. Then let me again come to the PPT. Then here, this is Ceylon Ayurveda Private Limited, your company till the end of your examination. Okay, then we will look at, as first, we will look at the company overview. This background information of the company is critical for your Lamai. Why? Because you should know the nature of the business, what they are doing, and what's the structure they are having as a company. Why it should be important? Because for you to apply the income tax rate correctly, and also not the income tax, but also for you to apply, maybe in some scenarios the value added tax has been tested. Then therefore, for you to have that particular knowledge, then application of the income tax rates, application of the value added tax, then the nature of the business is very, very important. Even recognize the allowable expenses, recognize what to disallow. All these things, this nature is important. Therefore, firstly come for this. The name of the company, remember the name of the company, it's Ceylon Ayurveda Private Limited. And you can see, Lama, it's a private limited. It's a private limited. It's not a quoted public company. It's in the pre-scene, it has given CAPL, the short name. Okay. Then what's this nature and the nature or a principal business activity of this organization? The company, what is given, manufactures and sells healthcare products, Ayurvedic, pharmaceuticals, herbal, beauty products, oil and beverages. This is their principal business activity. Now, by looking at these, this is given in the pre-scene, page 2, in the subtopic 1, subpara 1, this is very important. The company, what they are doing, manufactures and sells the particular products they are given. And it owns many agricultural sorts of land in Kandy and Paduka to cultivate herbs. They are doing manufacturing and selling. To manufacture these healthcare products, Ayurvedic products, and these pharmaceutical products, one of the key raw material is the herbs. How they are sourcing these herbs, it's from their own lands. Don't forget this structure of their manufacturing process. Okay, then they are having their own lands. From that cultivated herbs, it's coming to factory. They have 2 factories. One is located in Kandy and the second one is located in Paduka. Then this in the page 2, subtopic 1, subparagraph 1 of your pre-scene analysis. And CAPL began to export its product to overseas market in early 2003. Now for this sales part, I can add 2 things, Lamai. They are doing local selling in one hand. In the other hand, they are doing export sales. Now, if I have taken output from their entire process, if I have taken their output, they have manufactured products. It's totally coming under healthcare, pharmaceutical, cosmetics, and the herbal products and the beverages. This product portfolio, they are selling to local market as well as they are selling to export market. This is as straight if we have seen the organization, what we can see. Then come to next, today the company has become a research-oriented company. Why they being a research-oriented company? The reason is their industry. They are manufacturing pharmaceutical, herbal, these beverages products. For that, they need to do the value addition time to time. We cannot use the same thing. If we have used the same formula before 10 years for today's contents, very especially for this healthcare products, we cannot be in the same stage. Therefore, then the research center, that's mean in-house research center they have. In which year it has started? Then CAPL set up a research and development center in financial year 21-22. Then this is critical. This is if I have taken as your testable year of assessment, it's a 21-22. In that same year, this research center has established on behalf of the CAPL. Then this is an in-house research and development center. This center was set up to develop new products. What's their main purpose? To develop new products. That means to add in the healthcare products other than existing products. They need to go for the new products. Then Ayurvedic pharmaceuticals. Then that in the product range, they need to go for the new product. Then to meet the first reason, high quality standard required by the customers. Then this is while going for the new products, again, improving the business process. I think you can understand by this wording given. It's by improving the business process while they are developing a new product. Now, this is the principal business activity of the business, the organization CAPL. Now come to next one, which is the continuation of the company overview. The sector they are in, we are looking at by the output, you can see it's a manufacturing and selling to local market And from 2003 onwards, they are selling to export market. This is what you can see. And the date of incorporation, 1979. And shareholding structure. This is very, very important. Why this is important? As a tax consultant, you have to provide the advisors to the board of directors, the shareholders. Then you should know the consisting, what is the composition of the shareholding. Come to here, 80% family owned. This is family owned and overseas institutional shareholder, which is the BRC. Then 80% family owned, 20% Blue Rock Capital, institutional shareholder, and this is the structure. The shareholder is having a focus to, which is overseas shareholder, much concern on going for the listing, which is in the DIRISA report, and they are looking for sustainability reporting, and they have the environmental focus, then that concerns are there. And again, if I have taken this 80% family on, which is the Herat family, in that Saman Herat, which is a co-founder of this organization, CAPL, he has 40%, the Ruan Herat 20%, and the Hansi Herat 20%. This is the 80%. In here, what I really need to emphasize, you need to look at 80% family owned, okay. Now, the other shareholder, the institutional shareholder, which is Blue Rock Capital, that person is my overseas institutional shareholder. Then looking at that wording, you need to understand, okay, this is not this person or this shareholder being an institutional shareholder is not a resident person. That's the first thing you have to remember. He is not a resident person. He is a non-resident person. Therefore, when looking at the arrangements, strategies given to the company, when it applies to this non-resident person, you have to look at into that angle, not from the resident person angle, but from the non-resident person angle. Don't forget this. It's very clearly in the pre-scene given. It's an overseas institutional shareholder, not a resident person. Remember these points. And next one, shareholding structure. The page 2, subparagraph 2 of the pre-scene. The shareholding structure given, it's a 8 million number of shares at rupees 12.5 share. The value of share capital, its stated capital is 100 million. It's in the financial position. If I have gone for your pre-scene, then in the pre-scene, it is there. In here, it is there, and again in the financial position, it's very clearly mentioned, which is this is the forecast, and here statement of financial position, it has given stated capital 100. Okay, 100, and you can see it's given in millions. In the all the figures given in millions. Then let me again come to here. And again, this is the shareholding structure, and which I need to highlight, this Blue Rock Capital, the overseas institutional shareholder, non-resident person. Then this is the extraction from the pre-scene, a product portfolio and the percentage of the revenue. It's in the page 4 of the pre-scene. Now, product portfolio and the business development, main product categories of CAPL, healthcare, under that toothpaste, hair oil and health supplements, pharmaceuticals, mainly pain relief, Ayurvedic medicine, and we have herbal beauty products, facial the cleansers and toners, skin moisturizers, the body wash, and the essential oils and the beverages in the tea. Now this is my product portfolio. Now how this product portfolio we are going to manufacture. This is in the real life example which we can see in Sri Lanka. Now come to here, which is the product portfolio and percentage of the revenue. Again, this is page 4 of the presentation. This is important. Why this is important? For you to identify in the product, if you are taking a decision, then for that decision, if it is product wise, if you have to provide, then for that this is important. Healthcare 25%, pharmaceuticals 15%, herbal beauty products 20%, essential oil 35%, beverages 5%. Now from all these details, what I need to come, this is the perspective. I need to come for the tax perspective of the CAPL. What is the tax perspective? When you are writing the answer, this is your question 3 in section 2, entire 50 marks given. In that 30 marks, which is the highest marks allocated question, which is resident company taxation, other 2 parts, or it's a subdivided, more or less it's coming under business decision making plus tax planning, tax administration plus transfer pricing, and again with the case law provisions as necessary. Then for you, how are you going to apply the tax perspective for this CAPL? 2 things, Inland Revenue Act with reference to income tax and the Value Added Tax Act with reference to the application of the provisions of the VAT. Come to here, income tax, Inland Revenue Act number 24 of 2017 and subsequent amendment through amended Act number 10 of 2021. This is the last amended act. Then the relevant gazette notification. What are the gazette notification? You all know. Please have these things with you all. Then this is the scope. And again, for value added tax, it's a from 2002 to up to now, all the amendments, it's a before the latest one, it's Act number 9 of 2021. And again, from with effective from Jan 2022, there is Act number 13 of 2022. And relevant gazette notifications. And very importantly, for this reason, I need to link the VAT exemptions. The VAT exemptions, because it's critical for you to know what exemptions applicable to our company, CAPL. Okay, then let me come to next one. By knowing entire business process of the organization, I need to come for the application of the income tax rate. That's the main thing, the application of the income tax rate. Now, I need to analyze this through 2 angles. One is, as I have explained to you, one based on the output, which we are manufacturing that product and selling to local market, as well as selling to export market. That is one angle. Let me do it first, which is income tax rate. I have very clearly given this is applicable for output finished product. That means that manufactured product portfolio. Then I'm looking for this one. The products are there. Then in that sense, in here, based on the different gains and profit, first schedule para 4 subparagraph 2A. You know the first schedule is for tax rates. In that subparagraph 4 is for the tax rates applicable for the companies. Subparagraph 2A for the tax rates applicable with effective from 1st January 2020 with reference to the gains and profit of a company. Then when looking at this output, we have 2 gains and profit. One is gains and profit from the manufacturing and selling to local market. Second one is the manufacturing and selling to the export market. Now, these are the two angles. Let me come to here. Export income, it's a subpara B, which is subpara B mean first schedule, subparagraph 4, subparagraph 2A, subparagraph B. I have linked to this part, and after that, take in that next subparagraph to here. The gains and profit from conducting a business of sale of goods or merchandise. In our case, it is sale of goods, including export of goods. Yes, we are doing export of goods. Where the payment for such sale or export is received in foreign currency. Obviously, it should be received in foreign currency and remitted through a bank in Sri Lanka. Then the rate is 14%. Then the next one, which is the manufacturing and selling to local market. It is in the first schedule, subparagraph 4, in that subparagraph 2A, subpara M, which is gains and profit from manufacturing. It is 18%. But in that 18% rate, all of you all know, it has excluded these things. What are those? In that subparagraph 2A, paragraph A, B, C, J, or K. What is A? A is the SME. What's the applicable tax rate for SME? It's a 14%. If I can go as the SME, then I need not to apply the 18%. In our case, no, we are not the small and medium enterprise. We have the turnover more than rupees 500 million. And secondly, B is this, which is the export of goods and merchandise. If I can go with that, then I need not to apply the 18, I can go with the 14. The C is for specified undertakings. Then if I can go with the specified undertaking, I need not to come up with the 18%. Then J and K, it's again, for that particular gains and profit it's given. Then if this A, B, C, J, K, if these things rate is 14%, if that 14% is applicable, then you need not to go with the 18%. This is analysis of the tax rate merely based on the output finished product. Okay, what we can see at a glance, if I have seen, this is that structure. But I need to go beyond this. Come to that analysis, which is here. The second analysis of the income tax rate, which is income tax rate based on the deemed sale to what? Deemed sale, I will explain. Deemed sale and process through agricultural lands to, from the agricultural lands to factory. This is additional point to a student. But this is additional point, but I really need for you to remember this structure, and in a very clear mind, if you can, this way it has tested very clearly without being a panic, you have to apply this. One is this method. If it has examiner given with based on the output, if it has given manufactured and selling at the export. And the second part is analysis of the business process, but I am very keen about this one. Come to here, nature, principal business activity of the business. What is they are doing? Company manufactures and sells healthcare products, Ayurvedic pharmaceuticals, herbal beauty products, oil and beverages. This is their business. How they are doing that? I need to look at that one. How they are doing. It owns many agricultural plots of land in Kandy and Padukka to cultivate herbs. They are having their own lands. In that lands, they are cultivate their herbs. And the main factory is located in Kandy and second factory is located in Padukka. Then it's indirectly telling from this lands that herbs, it's coming to the factory. Keep keep that in your mind and come to the process. Analysis of the business process to apply the tax rate. First thing, what's the starting point? They have agricultural plots of lands. What they cultivate herbs. From that herbs, it's coming to the factory. That herbs, it's coming to the factory. Then that factory, it may be a part of the agro processing. It may be part of the manufacturing, but as per given information in the pre-scene, the agro-processing part is not talking about, but it's highly talking about this manufacturing part. The factory can be happen two things. One is agro-processing, other part is manufacturing. Maybe both, but the information it's not given, but in the very clearly given, they are doing manufacturing. That wording has given. Then I am more keen about this arrow. From the factory, it's coming to manufacturing. After manufacturing, they are selling to local market and they are selling to export market. Lamai, this is in-depth analysis of the business process as it given in the pre-scene information. Now from this, the agricultural plot of lands, the herbs come into factory. If you're cultivating the herbs in the land, what is that? It is the agricultural business. We can divide into two. One is agro-farming, other one is the agro-processing. Then what is this? The cultivating herbs in the plot of lands, it's agro-farming. And that herbs come into factory. Then in the umbrella of the CAPL, it's not a separate subsidiary. It is in the umbrella of the CAPL. Then therefore, this agricultural plot of lands and herbs come into factory. How we are pricing it? Now, these are the issues we need to think. From our own factory, we are receiving our herbs. Then is it free of charge? Or do I need to charge a price on that? But definitely in the arm's length pricing, do we need to charge a price or not? Yes, we need to charge a price on this. Then these things is a very critical. I think now it's something open for you all. Then let me come, if it is so, what are we going to do? Then come to here, then raw materials used for the business process. Now, these herbs, is it our raw material? Answer is yes. In the pre-scene, it has given these are the raw materials. The company uses many types of raw materials in its manufacturing process as follows. Extracts of natural ingredients. The total, it's the raw material. The herbs, it's nothing doing anything. It's purely that particular herbs. And natural products, the herbal materials, again, it has given herbal materials and the additives, which is extract, the extra things, which are add-ins for this process. Then, apart from the above, the solvents, detergents, liquids, and powder and packing materials are also used. Now, by looking at this word, Lamai, the sentence, what you all can understand, it's they are adding some chemicals that mean particular the extra things, which is additives to that product, the particular product when manufacturing and completing it as a finished product. Remember these things. Why? Let me come to next part. This is the reason. This is the reason the applicable tax rate for manufacturing and agro-processing. Because I don't know it's a manufacturing, agro-processing, if maybe both, maybe manufacturing. I'm key concerning on this manufacturing rather than the agro-processing. then here, we need to look at, in this kind of the scenario, what we can do. Come to here, applicable tax rate for manufacturing and agro-processing. Para 11 of the first schedule is for tax rates. In that, para 11 of the first schedule, the tax rate, this is given for tax rate. Please remember, tax rate for persons who engage in agro-farming together with agro-processing or manufacturing. Now, what our business? We are doing agro-farming and together agro-processing or manufacturing. Most of the case, lamai manufacturing. Now, we all know we are doing agro-farming and the manufacturing, agro-processing, it's not clear, but these two is there. If so, where a person utilizes agro-farming produce produced by him for his agro-processing or manufacturing, and I'm again coming to this one, as per the information of the preceding, manufacturing business activity in Sri Lanka, yes, such portion of the tax payable in respect of such agro-processing or manufacturing business activity that corresponds to the proportion of the farming produce produced by him to the total farming produce utilized in such agro-processing or manufacturing shall be reduced by 25% for the period of 5 years of assessment commencing from 1st April 2021 for the tax purpose other than the deferred tax. This is the first year of assessment, which is this coming into application. Clear what this has mentioned? This has mentioned I'm doing together agro-farming and manufacturing or agro-processing. In that, if I am using that agro-farming products, which I have cultivated, that product directly to my manufacturing or agro-processing business, then in that, for that proportionate, then you need to reduce the income tax rate by 25% for a 5 years period. Now, in here, okay, then I will come to your questions later. I will answer all your questions after I'm coming to here. Okay, the presentation is available for you all for sure. Then again, come to here. What it has given. I am in the agro farming and I am doing manufacturing and agro processing or manufacturing or agro processing. In that content, then I'm using my agro farming products to the manufacturing process. If I'm doing so, I have a reduced tax rate for what my agro processing and manufacturing. Agro processing, what is the tax rate? 14%. Manufacturing, what's the tax rate? 18%. For that reduction of the 25%. In particularly, if we cannot quantify what is the agro from the agro farming, what's the percentage came into the agro processing. Now, I'm not talking about the manufacturing. I'm talking about the agro processing in the plantation, that sector. It's a 68 to 32, that percentage is maintaining. But in our case, it's not like that. It's a total agro farming is used for what, Lamai? For the manufacturing. For the manufacturing part based on the given scenario of the pre-scene. It's more or less, but you have to look at the unseen, you have to read very carefully. Then this is on the reduction. Now you need to know about what is the agro farming what is the agro-processing, what is the manufacturing. We need to look at all these three, come to that definition under section 195 of the Act, which is the interpretation section. What is agro-farming? Agro-farming means in section 195, the tillage of the soil and cultivation of land with plants of any description. That's why it's applicable to us. We are cultivating herbs and this provision is open. The cultivation of land with plants of any description. Then cultivation in greenhouse, beekeeping, the rearing of fish and sheep farming or animal husbandry, poultry farm, the haystack and the veterinary or the artificial insemination services. Now, from this A, what my key concern is on the cultivation of land with plants of any description. It tally with what we are doing. And the B, the cleaning, sizing, sorting, grading, cutting or chilling of any produce out of any activity referring to paragraph A by any person who is engaged in any such activity in preparation of such products to the market, but exclude agro or food processing. Agro processing has excluded from this. Then, but in our case, it's more or less linked to paragraph A, cultivation of lands with plants of any description. Now come to next one. What is the agro-processing? It's a continuation of the same discussion. What is agro-processing? In section 195, agro-processing means the processing of any locally produced agricultural, fishing or animal products. Now, it's agricultural products, then fishing or animal products, and includes an undertaking for the dehydrating, milling, packaging, canning for the purpose of changing the form, the encounter of the physical appearance of such product or in preparation for the market, but excludes an undertaking of the deep sea fishing or manufacturing. Now you can see the manufacturing has excluded from the agro-processing. Agro-processing tax at the 14, agro-farming exempted, manufacturing at the rate of the 18%. And what is agricultural business? Then මෙතන හැමතැනම කියනවානේ agricultural කියලා. Then what is agricultural business? Again in section 195, agricultural business means the business of agro-farming or agro-processing. Now both things we have discussed, what's the agro-farming, what's the agro-processing, but excludes farming or processing of liquor or tobacco products or products as the case may be. The liquor and tobacco has excluded. Now that part you all know. Now I need to come for the manufacturer. What is the manufacturing? The manufacture in section 195 means a change in the, now you can see the word now, change. The change in a non-living physical object, article or things resulting in transformation of such object and article or things into new and distinct object. Now what are we doing, Lamai? Converting herbs to particular different kind of the products. Article or things having different name, character or use. That's why I am more concerning about the manufacturing and agro-farming. My key concern is on the agro-farming and the manufacturing, okay? Then B, or other than this, bring into existence of the new and distinct object, article or things with a different chemical composition or the integral structure. Then again, I'm coming more focus on the part A, Now you can see what we are doing in the lands. There are herbs. That herbs, it's not as the usual same form. We are changing the form and we are manufacturing different products. It's not only packaging, it's not only dehydrating, then it's adding some extracts and extra things, and we are changing the entire form. Then these definitions are important for you to understand the business nature and the business process. Now, being with this, now you know manufacturing, no, processing, no, agro farming, okay, agricultural business, and for manufacturing 18, and agro processing, if it is there, 14, and agro farming exempted. The export 14%. Now come to next one. Next key concern on me, from the agricultural plots of land, that particular raw materials come into the factory from own lands of the CAPL, as well as there are outgrowers. In the pre-scene, it has given. There are in the latter part of the pre-scene lemma, it has given. There are outgrowers also, not only in my own lands, but also there are farmers who are work for us. But it's not my own lands, but the company is given the instructions to them how to do this, and they are providing that output. Then for them, we are purchasing at a price. Then what happened from our own factory? We are from our own lands, we are taking it to the factory. Then what's the price are we going to charge? Let me come to that. It's very clearly given in the Inland Revenue Act. The income tax rate, under that, I'm in the topic of the income tax rate. Under that, exemption on agro farming, third schedule, para U. This is the exemption, and what it has mentioned, what is the exempted gains or profit from the agro farming. Let me come to here, the para U. The gain and profit earned or derived by any person, in our case, CAPL, from, in that Roman 1, the sale of products from agro farming of such person within the period of 5 years of assessment commencing from 1st April 2019. Then 1920, 2021, we are in the third year of exemption. 21, 22 years, we can claim the exemption. And what it has given in the third schedule, if you have gone for a amended Act number 10 of 2021, in that amendment to the third schedule, this is very clearly given. Come to this paragraph, provided that this is given Lamai, how to compute in here, it is given how to compute exempted gains and profit. Gains or profit. Exempted gains or profit. How to compute? Provided that in relation to an undertaking which consists of the production of agro-farming producers and utilizing such produce to agro-processing or manufacturing, same as in our case. Then of any product, such produce shall be deemed to have been. What's the meaning of deemed to have? Is it actual? No, it's considering as, or rather we have to consider it's like this. How? Deemed to have been sold for the agro-processor or manufacturer at the market price. Now from the agricultural lands, when that herbs come into factory, at what price the land from that land, if I have taken a separate SBU, if I have taken the agro farming as a separate SBU, then or a separate division in the CAPL, in that from that division, if I have taken the factory as a division or SBU2, then in that lamai, from the land, the herbs should be transferred to factory at what price? At the market price prevailing at the time of such deemed sale. Now, how are you determine the market price? Now, in the pre-scene, if you have gone to the pre-scene, in the pre-scene, it has given, where it has given, it is given not only from their agricultural sort of land, but also they are purchasing the, here. They are purchasing the herbs from the outgrowers. Come to here. It is in the page number 5 of the pre-scene. It's under the heading of the product portfolio and the business development. In that, let me come to here. The cultivation of medical plants is carried out in the Western Province and Central Province. CAPL has also appointed many outgrowers and supported them through a loan scheme. In this project, there are over 400 small-scale farmers who receive advice on novel agricultural practices and the equipment. You can see. Now, how to go for the market price? We have the cup method for us. Then the market, the benchmarking price is with us. At what price we are purchasing it from the outside growers? In the same price we can take from our own lands. Then you have to think these things very clearly. In that has given, we have to take it from the market price. And the gains and profit computed on the basis of such deemed sale in relation to agro farming shall be considered as the exempted gains and profit within the period of 5 years of assessment commencing on 1st April 2019. Here, you have to take that deemed sale and the cost you need to analyze. I don't think so, in the, more or less, you know, in the section 120 in the record keeping, we have to prepare the separate sets of financial statements with reference to different gains and profits. Then if it is 14, 18, 24 and exempted, even in the first schedule, it has very clearly given with effective from 1st April 2021. You have to go with the separate financial statement or separate sets of accounts if you all having a different tax rates which are applicable to different gains and profits. Then in your paper, if this in-depth it has tested, then it should be provided at least a ratio, at least a particular detail should be provided. If not that, in a first, which I have analyzed as the output, manufacturing and selling to local market, manufacturing and selling to export market, if it has gone with that basis, then it's a 14 and 18, even that the particular the allocation of the expenses and all these things should be given because it's the two gains and profits. And in this part, if up to this level it has tested, then in that case, all the details should be provided. Okay. Then this is on how are we going to ascertain the exempt profit or gain with reference to agro farming, the situation where in the same our own lands, we are taking the raw material, which is herbs, as the raw material to our finished product. In the third schedule para, it has very clearly given you need to take it as a market price. It's very clearly given. Then do we have a market price to take? Yes, we have, because we have the outside growers. From the outside growers, we need to buy our herbs. Then buy their herbs to use our process. Then therefore, that what is the price they charge, then it is we can charge. And the transfer pricing, arm's length pricing, the cup method, if I have gone little bit behind the pre-scene, go through transfer pricing, one of the hot topic. I don't know wherever in the paper it may be there. Therefore, please have that knowledge of the transfer pricing also when we are coming to here. Okay. Now, after analyzing up to this, let me come to, if the worst case scenario happens, what are you all going to do? Income tax rate accordingly, which is on the deemed sale based on the process of the business. If I have analyzed the income tax rate accordingly, if separate accounts provided or allocated ratio given for each gains and profit from business, this is I'm talking about business, then gains and profit from agro farming exempted from income tax. Gains and profit from agro processing, if any, if any, it is 14%, but subject to 25% of the reduction, as I have discussed in the reduction to the tax rate. If it is so, 10.5% effectively. Gains and profit from manufacturing, definitely we have, it is 18%, but under this process, subject to 25% of the reduction, effectively 13.5%. Gains and profit from export of goods, for that this 25% reduction not applicable. Then it's a separate undertaking. Then gains and profit from manufacture of goods, it is 14%. Clear? Then these are the tax rates if the worst case scenario happen. All the process, particular tax rates applicable. And again, which I need to tell, which I need to tell on this lamai, if this allocation ratio separate accounts not provided, then in the past papers it's very clearly given, exempt undertaking, exempt profit separately given. Then you can remove it from the profit before tax. And if that these are the separate manufacturing and the export, if it has not given, in worst case, you can go with the business profit. It's on the business, then it's a business income. That business income divided by total turnover and into export turnover and into manufacturing turnover. I'm not much keen about the agro processing, but we don't know. Then therefore, please know all these things. And come to this note, all this based on the information. If my sound's not clear to you, please put a message to the chat box. I think still it's okay. Then all this application will be changed based on the information given in the unseen. This is what I can do. I can see from the pre-seen. This can be changed based on the unseen information. Therefore, my request, read the unseen very carefully and apply accordingly. Therefore, read the unseen carefully, apply the rates accordingly. This is only the analysis based on pre-seen and income tax law applicable. All the analysis with the process of the business it has provided, as we can see. Okay. With this, please go through transfer pricing. Then that one also important in anywhere in your paper. Then this is on the rate. That part has done. Now I need to come for it's an income tax rate for the business income now. then we need to look at income tax rate applicable for the investment income. Now, you know, in the resident company taxation, we have in the assessable income. More or less, it's other income is a scenario basis. If I have taken the past papers, then it's a tested business income and investment income. Then for the investment income, what we have to do? Interest income or rent income, which is categorized under investment income, not effectively connected to the business, it is 24%. Normal tax rate under first schedule para 4. Then next one, which is dividend income. What's the dividend income? It's a gains and profits from dividends received from a resident company. It's a 14%. It's a first schedule para 4 2A. Then gains from the realization of investment asset, it's a 10%. But all this subject to exemptions mentioned in the Inland Revenue Act. Interest income, yes, we have exemptions. Interest income received from the foreign currency or interest income received from the special accounts maintained in a commercial bank in Sri Lanka, even in the US dollar, even in the LKR, then it is exempted from for first one, foreign currency denominated accounts in the commercial, in the banks. Secondly, that too. And with reference to rent, no exemptions actually. For dividend, we have the exemptions. Then with reference to dividend income received out of, that means dividend income for me, received out of the dividend received to that company, or rather dividend distributed out of dividend received, it is exempted from the hands of the recipient. Again, from the realization of investment asset, the disposal gain from the realization gain from the listed shares, it is exempted. And with reference to individual, the gain from the investment asset, which is 50,000 or below 50,000, then it is exempted. Then these things, subject to that things, it is exempted. Then the rest of the part only liable. Then therefore, don't apply all for this 24, 14, and 10. Look at what is the part nature of that. Then after that, apply accordingly. This is on the investment income. Then next one, this is all about the tax rate. Then I need to come for the possible issues which can be happen in your examination. Okay, the tax perspective, possible issues may in the pre-seen, that means may pre-seen to in the unseen. We will look at what are those. It has very clearly given Lama expansion strategies. The 3 expansion strategies given. There are 3 expansion strategies according to pre-seen, which is listing on the Disavi board. Second one, overseas expansion. Third one, expansion of the local distribution networks, which is outlets. It has given plan of the local distribution networks. Now come to here, possible issue 1, listing on the Dirisavi board. Then for this, Lamai, what you all need to think, this listing, this is initial public offering. The IPO, that's meaning the Dirisavi board. Then this is the first time they are doing, and in after that, no listing in the Dirisavi board. After that, it's a subsequent share issues. For this, this is a capital nature transaction. This is a capital nature transaction. What my concern, any expenditure, that means this is not happening in 21, 22. This going to be happening the after that 22, 23. Then maybe the pre-expenditure for this one may be charged into income statement. Any expenditure charged to income statement as a prerequisite for the listing of the Dirisavi board shall not be allowable deduction. It should be disallowed. Why? It's a capital nature expenditure. Then come to here, recognition of capital nature expenditure when computing the business income. You have to apply the section 11. This is a one thing. And Lamai, the listing on the Dirisavi board, other than that, we don't have to think much because it's their own decision. They have taken that and they have to go with that decision. We need to look at the subsequent consequences on this decision. Now I need to come for second one, which is the overseas expansion. Possible issue 2 in the overseas expansion. How to finance? Now it's one of the key decisions as a CAPL we have to take. How to finance this overseas expansion? It has given as per pre-seen from the money collect from the listing. Then in that page 3 of the pre-seen, Blue Rock Capital has intimated its intention to get CAPL listing on the Dirisavi board. In the next financial year, now we are in 2021-22, being the next financial year, this is talking about 22-23, the financial year ended 31st March 2023. And someone, the chairman has agreed to this. That's why I have mentioned whether going for this one and whether going for any other option, the evaluation of that two option is maybe not possible because in the pre-seen it has evaluation can not for any perspective. You need to have the tax perspective on this. Then it may it's not commonly coming because the decision already taken. For that it has agreed. Then CAPL hopes to issue new shares to Blue Rock Capital in the next financial year. Then for the overseas institutional shareholder is that 20% may be increased with this decision, which will be leads to dilution of 80% currently owned by the family. Yes, of course, if it is going to the overseas institutionalized shareholder, then obviously this 80% going to reduce. Then these funds are expected to be used to increase the production capacity in order to meet the demand of the overseas expansion. Lamai, this overseas expansion, it's not given that we are going to have a branch in one of the countries. No, but in the pre-seen, it has given we are in the export market. Then for export market, what are our deliverables? We are delivering our products. Then they need to go for the increase the production capacity, even the existing product portfolio, or else even the new products, they need to increase the number of products. It's a production capacity mean it's not maybe, it's a number of the products with the quality. Then they need to maybe same products, maybe new product. Then the selling to the export market, they need to increase. And this is not telling Lamai they are going to have a branch office in overseas or else they need to have a separate company incorporated in the overseas. No, this is looking for the production, increase the production capacity in order to meet the demands of the overseas expansion. Then we don't know, based on the pre-seen information, it's increased the production capacity, but maybe in the unseen Lamai, it's maybe given they have form up a company or they have a branch. Then likewise, but according to information, it's the increasing of the production capacity to the overseas market, which is my export market. Okay, then how we are going to do that? By way of the free cash which we have, which we are obtained from the listing in the Dirisavi board. Okay, then this is on the second expansion. I need to come for the financing option while explaining the third one also, and link to the second one and third one. I need to come to that. And the third one, possible issue 3, expansion of the local distribution network. Open a few company-owned retail outlets in the Western province, which is in the page number 4, it has given. Then target in 22-23, I'm looking for very recent financial year for us, which is 22-23. It's a 2 outlets. It's in the pre-scene, it has given the, if I have come into this one, it has given the plan for 22-23 to 23-24 to, and likewise, and in the pre-scene, it has given per cost for this. It is the investment per outlet is expected to be rupees 20 million per outlet. Then in 22-23, we are going to start up a 2. Then it's obviously 40 million. Then come to here. It's a target 22-23, 2 outlets. Value of investment, it's a 40 million. That's mean for one, it's a 20 million. Then how to finance? I need to come this to issue 2 and issue 3 board, because we don't know in our unseen the listing has happened, or that's mean it's a, if maybe they are in the decision of the, we are not going for listing, whatever can be happen. Then this very open, and I need to take this one for overseas expansion and the expansion of the local distribution network. If the listing option is no more, how to finance? We need money, how to finance? Then based on the pre-scene information for 22-23, I'm looking for tax planning perspective, not for 21-22 I'm looking. Then for that, one option, we can go for the borrowing, especially for the outlets. We need to, the way of financing not given, then either debt financing or from money received from IPO. It's not equity financing. Equity financing is happening to the overseas investor. He is investing in our equity. Okay, I think it's understandable. We have now already 20% he has or institutional shareholder invested. Upon this listing part, again, that institutional overseas institutional shareholder is investing in shares. Then from that shareholder's perspective, he is investing in the shares. Then from our side, CAPL, then we need to go for, one is the debt financing, second one, using the money which we have received from IPO. Now you have to balance these two. You have to select what is a good option to go. Now, Lamai, the IPO money is the free cash we have. That means it's a zero. It's not a zero cost, but we have the opportunity cost. But it's the what in our hand. Then debt financing, if I have gone for debt financing, for that we have to pay the interest on that. Then for that, this is not the 21-22, it's for the 22-23, the taxation and business decision making and the tax planning. For that, then you need to look at the finance cost from the debt financing. What's the major the benefit which we have with the finance cost is tax deductible. But in the taxation, to finance cost to tax deductible, what are the criterions to be satisfied in section 12? It should be incurred for the production of income. Secondly, it should be for the purchase of asset. That asset should be used in the production of income, the section 12 application. When it comes to year of assessment 21-22, we are only applying the section 12 application. Why? What's the reason? From the 6th schedule under temporary concession, only for the year of assessment 21-22, the finance cost restriction under section 18, it has suspended. Therefore, only for the year of assessment 21-22, we are not applying the thin capitalization rule, which is the year-end stated capital plus reserves other than revaluation reserve into 4 times. Note that with effective from 1st April 2021, we don't have 2 options as the 3 times or 4 times. We only have 4 times. Then that particular application, even it has applicable with effective from 1st April 2021, for year of assessment 21-22, it is not applicable. Why? We need to go for the most specific deduction. It's in 6th schedule. It's suspended. Therefore, now application for 21-22 difference, but when it comes to 22-23 years, you have to apply section 12 and you have to take the finance cost which is eligible to deduct. From that eligible finance cost, you need to apply the section 18, which is the stated capital plus reserves other than revaluation reserves into 4 times. Okay, if it is so, Lamai, I need to come for, I'm looking for whether my finance cost is allowable deduction. Based on the pre-seen information in here, I have profit in the unaudited financial statements. If this is continuing the 22-23, the forecast has given. You can see the forecasted 5 years forecasted financial statements given. This is 22-23. Then in that, the stated capital and this retaining earnings is a good position. And after that, the withall for the 22-23 given. Now you can see my stated capital plus other than revaluation reserve, the retaining earnings, 125 million plus 1.9 billion into 4 times. And you can see loans and the actual borrowing 425, and in that short term part 225, and the bank overdraft 20. Then it seems to be for 22-23 we are in a good position. That's mean my finance cost can be deducted, but you have to read the unseen very carefully. You have to read the unseen very carefully. For that, you need to look at whether this borrowing has utilized for the production of income. If in the local distribution network we have invested, from that, throughout the year, if we have received the income, yes, I can deduct. In the overseas expansion from these products, which is from that, if I have received the income, yes, I can claim the finance cost. Section 12 satisfied, then apply the section 18, and after that look at what's the actual borrowing and look at what's my stated capital plus reserves into 4. Then if I am in the good position, yes, my finance cost is tax deductible. What's the meaning of tax deductible? When arriving into business income, you can deduct. When in the profit before tax is already deducted, then I can continue as the deduction. For this thing, you should need to know. Okay. Then here, evaluate 2 options under tax planning perspective. I'm not looking for 21-22. I'm looking for 22-23. And I have analyzed the forecasted figures for the 22-23. The debt financing interest cost is tax deductible. We have free cash, and again we have the money from the, if I have gone for the debt financing, we have that money. If satisfy the requirement of the section 12, but subject to application of the section 18, what's the year of assessment 22-23? And here for your reference, I have put these things. The application of the section 12, this is extract provision of the section 12. Please go through. And this is the application of the section 18 for the from April 2022. April 2022 because this is up with effective from actually applicable from 1st April 2021. but in the but for year of assessment 21-22, it has suspended. 2022, it has suspended. It has suspended to the 6th schedule. That's the reason, no? To the 6th schedule. Okay. Now this is extract provision you need to apply for the 22-23, which is we have only 4 times, not 3 times. The finance cost for the year, value of the financial instruments on which the finance cost incurred during the
Sorry, Nananjali, we can't hear. Hello?
Is it okay now?
Yes, now we can hear, Nananjali. Okay, now we can hear.
Okay.
I think
Sorry
from
for the
last 5
disturb.
minutes, we have not been able to hear from last 5 minutes. Yeah, sorry.
Okay. Then,
Okay.
which I have mentioned which is the application of the section 18. It's from the CAPL side. Okay. Then we need to look at the application from the side of the person who has given the money. If the person who has given the money, that's mean the loan or a borrowing, if it is a bank, I don't care about that. But the situation is this overseas investor, if he has changed his mind, if he has given the loan, if I'm going with the debt financing, and who is the person provides the finance to me, is that overseas institutional investor. Now I need to analyze a tax perspective from that person or that institutional shareholder side. What happening being a non-resident person? being a non-resident person, what it has happened, he has that person has given a loan to the CAPL. Then CAPL under arm's length pricing, CAPL need to charge that loan. There should be an interest charge at the market rate. Then in that interest charge, it is interest income to that overseas institutional investor. I am with the typical assumption of the institutional investor if he has given a loan. Then what's the situation, Lamai? With reference to that institutional investor, he is eligible to receive interest income from this borrowing. However, for him, that borrowing is, he has given to company, borrowing given to resident person in Sri Lanka. From that borrowing, what he is receiving interest income, it is exempted from income tax. Now you need to look at these angles from the both sides if that something happened. Come to here, under the expansion strategy, further, if borrow money from the institutional shareholder, this if, this not shall, this is if something happened. Non-resident person, because he is an overseas shareholder. Non-resident person, if given to evaluate it from the side of the investor, apply the exemptions applicable to non-resident person with reference to the benefit received to non-resident person. What is the exemption? Third schedule, para I of the Inland Revenue Act. In that, exemption on interest on loan given. This is the subject. Interest on loan given by the non-resident person, in our case, institutional shareholder, to Sri Lanka or government of Sri Lanka. Then it's given to me, the Sri Lanka. Then any person outside Sri Lanka on any loan granted to any person in Sri Lanka or the government of Sri Lanka by such person, it is exempt. This is from, in any case, in your unseen, in the as the financing mechanism, the Blue Rock Capital has given a loan to the company. From the side of Blue Rock Capital, the tax implication on the interest. And again, I need to come for next one, which is under expansion strategy, further elaboration. What is this further elaboration? Under this one or either or all expansion strategies, can we have exclusions? Can we have exemptions? Can we have concessions? We need to look at. Now, listing of the Dirisami board, Lamai, it's no concessions given. Concessions were there, but listing should be happen prior to 31st December 2021. Now it already gone. Therefore, I'm not coming to that part. But in the with reference to the overseas expansion and with reference to the expansion of the local distribution network, for this, we have typical two schedules, which is second schedule and the sixth schedule. Based on the investment, we can grant the enhanced capital allowances. But here, overseas expansion, is it new? According to the information provided in the pre-scene, it is not new. It is we are 2003 onwards, we are doing the business with the overseas. Secondly, expansion of the local distribution network. Lama, in the pre-scene, it's very clearly given. Currently, we have the outlets. There are frauds, there are misappropriation of funds with the distributors. That information given. Again, we are planning to have new outlets. That's the thing. Then it is again the expansion of the existing business. even in the overseas expansion, there are new products. It is going under pharmaceutical, it is going under herbal, then in the existing category, if this information has not changed in the unseen. Then therefore, for this one, you need to, according to pre-seen information, 6th schedule and 2nd schedule not applicable. Why? What's the reason I'm looking for? About 2 and 3 expansion strategy, overseas expansion, and the expansion of the local distribution network. In that, we can apply, can we apply 2nd schedule and the 6th schedule? No, shall not applicable. Why? What's the reason? Because the overseas expansion is expansion of the existing business is a one thing. Another one is a not invest in Sri Lanka. That's mean, Lamai, it's a to be the investment, it should be benefited to Sri Lanka. Now, I don't know this overseas expansion, whether it's going to branch, whether it's going to incorporate a subsidiary in another country, then we don't know that. Then therefore, the reason is it's even it's existing and it's based on the overseas expansion, then it's in the outside Sri Lanka. If it is branch or subsidiary happen, anyway, it is existing business, expansion of the existing business, then therefore we cannot go with that. But in any case, unseen information change, you have to apply it accordingly. Then the expansion of the local distribution network through outlets, again, expansion of the existing business, it is not the new. Then therefore, typically looking at the pre-seen 2nd schedule and 6th schedule, as it is, cannot apply. But please look at the unseen, read it well, accordingly apply. Okay. Then let me come to next possible issue. Now all 3 expansion strategies we have done. I need to come for the possible issue 4, which is the capital expenditure. We have Research and Development Center. Which year it has completed or which year it is there? In 2021-22. If you have seen the financial statements to the year, financial year in that 31st March 2022 here, you can see R&D expenses, financial information here, R&D expenses 151 million. And with reference to the last year, it's a nearly 100. It's a very close to 100% increase. And again, when it comes to your property, plant and equipment in your financial position, Lamai, you can see it is a massive increase in here. Then with that understanding, come to here, which is R&D expenditure, sorry, R&D center, recognition of the capital expenditure. In that, it is given many concerns. The finance controller is in a concern whether the company apply the correct way of the accounting standards, which is LKSs and the SLFRSs. Second thing, the auditor is in the concern also the capitalization of the expenditure is correct. Then please go through these areas because maybe some of the things in your question. Come to here, the total value of the property, plant and equipment of the company increased from the approximately rupees 1.3 billion in the financial year 21-22. The increase in assets was mainly due to the reason? Construction of the research and development R&D center. The main fixed asset items, the procured related to this building, plant, lab equipment and tools. The current capacity of one of the existing factories was increased. A few obsolete plants and machinery were falls off during the financial year 21-22. Now what happened? The research center, for the research activities only, they have building, they have plant, they have lab equipment and tools. What's the reason? It is to the research and development center. Why we need research and development center? To conduct the new product, research and development with reference to the implementation of the new product, implementation to the quality controls to the existing products. Then why we need this building, plant, lab equipment and tools? Only for the research activities. Is it for the production of the particular this herbal product in the factory? No. This is totally we have taken for the purpose of the research center. Then this is a capital nature expenditure directly used for the research and development. Can you remember in the section 15, it's a capital nature expenditure. You can deduct those. Then in that section 10 subsection 4 most specific deduction, it has given either you can go with the capital allowances, either you can go for the double deduction under 6th schedule, but don't go with the capital allowances, go with the double deduction, because in section 10 subsection 4 it's very clearly provided you should go with what? You should go with the most specific deduction. Then therefore this is capital nature, totally procural for the research center. Then therefore this is directly for the research and development purpose. Therefore even capital nature you can claim the double deduction. This is not in the income statement. You need to take this if the fraction, the value of these items is given, you need to take it and you need to apply the double deduction. For that, even in the earlier, if it has income statement, you're all taking 100%. That means one deduction. But here you have to take the total 200%, which is the additional deduction you need to take, because it's a one deduction and again the most specific deduction. Then therefore you need to apply both now. It's given in the unseen directly, and again it is applicable for the process of the researchers. That's the second thing, and the separate cost of these should be provided. If it is so, you can go further under section 10 subsection 4, the most specific deduction you can apply. The most specific deduction you can apply. Don't go with the capital allowances. Okay. Then it is the additional thing from the which unseen that paragraph, preceding that paragraph we can see. And the next one, for that, the funding to build the R&D center was obtained through bank borrowings. Total borrowing increased by nearly 440 million in financial year 21-22 compared to previous financial year. Again, when you are going for the borrowings, in that you need to look at whether the company is in the geared situation or ungeared situation. Can we go for the borrowing? That also the additional thing we need to look at. Then in the financial statements are given in the forecasted and the even in the actual, the historical financial statements for the 21-22 company, the net asset is more than the current liabilities, and these bank loans were obtained for a period of 5 years at the rate of 7% per annum for the first 3 years and the variable rate of the 4th year and the 5th year, it's given the finance cost information, which is for the research center. Now, Lamai, why this has given? What are you all think? Now, from the research center, do we have the income? Now, that you need to look at. This is an asset. Then from this asset to finance cost to deduct under section 12, what's the condition? From this asset, we should generate the income. Then in the nowhere in the pre-scene, it has given from the research center, is it incurred for the production of income? It has given 1 point, which is one of the existing factories was that capacity increase due to this research. Then indirectly, it has given, yes, due to this research center, we are generating the income compared to the previous years. We are generating the income compared to the previous years because it has given current capacity of the one of the existing factories was increased. That means the research center, that activities of the research center has helped to the increase the income. Then for these wordings are very important. Then it assumed to be this borrowing incurred for the production of income and can be deductible, but it's based on this sentence. If pre-scene information is different to this, then you need to look at. Then application to unseen. How this application to unseen, this detail, as I have explained, claiming of capital allowances for building, plant, lab equipment and tools. If these are directly used for the research activities under subsection 4, can apply the most specific deduction linked with the 6th schedule temporary concession. I have explained this. And the next one, which is the way of financing. Again, to finance the construction of the research center, a long-term loan has obtained to conduct finance cost, then attached to the loan for the year of assessment 21-22, then apply the provisions of the section 12, since through the 6th schedule temporary concession, the application of selection of the section 18 has been suspended. Don't apply section 18 for year of assessment 21-22, but for 22-23 onwards, you have to apply. Please have these things in your mind. And the output of the research activities, we need to look at whether from the research activities, what we have received. Now, from the researchers, Lamai, what we are normally receiving, maybe it's most of the cases, copyrights, patent, trademarks. Most of the cases we are receiving the patent rights and the copyrights. What are those? These are intangible assets. Is it an asset which we have used for the research, or is it an asset which we have received as an output of the research process? It is from the output of the research process. Therefore, this is what this is. If there is output of the research process, it's a normally patent or a copyrights. Then for these products, maybe it's a patent, then therefore it's an intangible asset. It's intangible asset. It's still in the financial position, there are intangibles. Then in that, you need to recognize the asset separately. It's not the part and parcel of the research and development expense. It is the output from the research center. It is the output from the research center. Then therefore, you had to recognize the asset used for research activities separately. And after that, that particular output from the asset, the output which we have received by utilizing this asset in the process of the research and development, then it's more or less, it's an intangible asset. In the intangible asset, first thing, you have to recognize separately the amortization of intangible asset. It should be disallowed. And thirdly, the capital allowances under fourth schedule in that the type of the asset, the class 5 of the asset category, you have to provide the capital allowances. Come to here. After it's a output of the research activity. This is on output, not the process. Then here, after the relevant R&D activity is conducted, due to that R&D activity, there may be identification of intangible assets, patent rights or the particular products. If so, such products shall be recognized under intangible asset and shall not include in the R&D expenses. And relevant capital allowances shall be provided based on the useful lifetime. Then you need to apply for this thing. It's the application of the double deduction rule on the research and development. Check the application of the section 15. You need to look at whether it's a scientific, industrial, agricultural research, whether it's a production process implementation, whether it's for the new product. In our case, it's the second thing. Then accordingly apply the 6th schedule. We can go with the product development and the process development through the in-house research center. Then the next one, the application to unseen, which is application of the double deduction. This is typically from the Act that provision. This will be expired in the last year is for the year of assessment 22-23. Then therefore, it's a your testable year of assessment 21-22. After that 22-23, this double deduction will be over. Okay. Then this is the particular provision in the Inland Revenue and therefore I'm not going to discuss it again. Come to next part. In here, steps to follow under research and development, which is capital nature expenditure. Page 6 of the present. Now there is an issue. What is the issue? The auditor has raised concerns about the capitalization of R&D expenses relating to the R&D center. Then in that, maybe capital nature expenses charged to the income statement. We don't know. Either thing can be happen. Capital nature expenditure may be in the P&L. Revenue nature expenditure may be capitalized. Maybe irrelevant expenses in this. Okay. Maybe capital nature expenditure charged to the income statement or revenue nature expense may be capitalized. So irrelevant expenses may be capitalized. What you have to do, whatever they have done, what you have to do, steps to follow. Check the nature of the expenditure, whether it's capital, whether it's revenue. Determine capital nature, revenue nature. Check the period of benefit. You know, for capital nature, it's a period of benefits going more than 12 months. Revenue nature, less than 12 months. Check the accounting treatment. It's a very, very important because under section 21, it's a act is very clearly given. You should go with what lamai generally accepted accounting principles. Then you have to look at what's the accounting treatment. And if asked to justify with case law provisions, apply accordingly. For capital nature and revenue nature, one of the key things, two case laws, which is Law Shipping Company versus CIR and the Odeon Associated Theatres versus John, for the taking the asset to the usable condition, not for the suitable condition. Not suitable, but for the taking the asset to the usable condition. These are the two case laws, very important, but please go through all case laws. Please go through all case laws which relevant to the capital and revenue nature expenditure. This is the steps which you have to do. And the next one, which is possible issue 5, dividend income received to the shareholders. Now you have two categories of the shareholders. One is the non-resident person, other one is the individual. For individuals, in the individual slabs, subject to exempt dividends, for the individual slabs, then they have to apply first 3 million at 6%, next 3 million at 12%, and the balance at the 18%. That is for individual, but subject to exemption if dividend received out of the dividend distributed by another company. Then for the non-resident, this institutional shareholder, he is receiving a dividend income from a resident company. Then what happened, Lamai? For that instant, that non-resident person receiving a dividend from a resident company, what you know? It is exempted from the income tax. If he has provided a loan to us, that interest exempted, then 20% invested by the Blue Rock Capital in our share capital. For that, that person eligible for dividend. Yes, we have declared the dividend in the financial year 21-22 as well as 2021. Then that dividend income is exempted from the hand of the Blue Rock Capital. Okay, come to that explanation. Shareholding structure: 3 individual shareholders, 80%, 1 institutional shareholder, 20%, non-resident person. Dividend will be taxed on the hands of the recipient. That means from the hands of the shareholders. Then thereby, 3 individual shareholders will be taxed at the progressive tax rate 6%, 12, and 18, subject to the exemptions in the dividend under 3rd schedule. Then declare the out of profit plus out of dividend income. Then maybe they have declared the dividend out of profit, out of dividend income, but you can see in the pre-scene it has given the CAPL has invested in the listed shares. Then obviously they may have the dividend income in their income statement under other income. Then by using that dividend, they may declare the dividends to their shareholders. Then therefore, that's why I have taken the hybrid version. Maybe declared out of profit, maybe declared out of the dividend income. Okay. Then overseas institutionalized shareholder, Blue Rock Capital, non-resident person. Dividend income received to non-resident person exempt from income tax as per 3rd schedule, paragraph double law Roman 2. What's that? On or after 1st January 2020, a dividend paid by a resident company in that the Roman 2 to the member who is a non-resident person, it is exempted. Therefore, no dividend tax applicable to such non-resident person. For that 20% invested in shares, the Blue Rock Capital does not have the dividend liability or the dividend tax on that. And again, if after the IPO, if they are purchasing shares, if the company issues furthermore shares to that person, then again the same implication, no change. Okay, then this is on the dividend income received to shareholder. You can see in the pre-scene before the forecasted information, it has given this thing, which is CAPL has invested in treasury bills and also in the stock market. By investing in the stock market, they may have the dividend income received. By using that dividend income, they can declare the dividends. Okay. Then this is a dilution of the shareholding ownership of the IPO. This is application of the section 64, not much, but I thought it's good to incorporate to here. The reason is, please read this, I will explain this. The reason is it has given the 80% shareholding can be diluted due to the share issue to the BRC. Then therefore, if it is ownership has changed more than 50% when compared to the previous 3 years of assessment, then it's considering as the ownership change, and there may be some restrictions. But however, it's a no evidence given, Lamai. They are going to change their business model. Therefore, automatically this is not applicable. But anyway, I have included. Please go through. That's why I have given the section shall not apply to the partnership or company, in our case company, that conducts the same business after the change as it conducted before the change for the period of 2 years after change. Then no evidence given that they are going to change the business model. Therefore, this may not be applicable, but please go through why we are taking a chance. Then the next one, possible issue 7, which is the fraud risk to the to many reasons, not only one reason. In the pre-scene, due to many things, it has given the fraud risk factor. Why? Because they don't have a proper accounting software. The IT that particular softwares are not good, and the distribution, that retail network, the distributors, they are. It's a evidence that they have done fraudulent activities. Then there may be misappropriation of the funds. That particular misappropriation of funds, can it be, if it has charged to the income statement, is it deductible or not deductible? Lamai, these are voluntary misappropriations, the fraud. Then therefore, this is not something involuntary, and rather this is not an expense, this is outgoing. In our act, we are not talking about outgoing. We are talking about only expenses. Then therefore, in here, more or less, this cannot be deductible. If that kind of the thing has tested, you need to justify it with maybe in the case law. Then how you are going to analyze that? Come to here. There may be fraud happen in the unseen, and the amount of the misappropriation has quantified and charged into the income statement. This is the impact. Anyway, there may be fraud, but if it has quantified and charged to the income statement, what's the treatment? Question, whether deductible expense or not. How to answer? Again, you have to analyze the scenario. These all scenario based. Apply the provision of section 11. Whether it has incurred for the production of income, or is it other than the capital nature? Lamai, this is not incurred for the production of income. And what is the definition of expense under section 195? Expenditure or expense means the payment made that reduces the assets of the person making the payment. Obviously, by making a fraud, Lamai, our asset, the cash and cash equivalents, it's reducing. But is it due to production of income? No, it's not compatible with the section 11. Apply the provision of case law. We have a case law, which is the Haley and Company versus the Commission of Inland Revenue. But Lamai, this is involuntary outgoing. Please keep in mind the scope of the case law. Make it have voluntary outgoing. This is talking about involuntary. This is something happened due to the burglary. Therefore, this case law, for apply this case law to the fraud and justify your answer, it is not telling that fraud shall be deductible. No, it's not incurred for the production of income. Then therefore, you shall not deduct. But again, you need to analyze the information given in the unseen. Come to here, apply the case law provision if required by the given examiner's requirement. It's according to examiner's requirement. Then the Haley and Company versus Commissioner of Inland Revenue. Special points to be remembered under above case law, which is the loss in this case. In this case, it's not in our case. In this case was allowed to be claimed on the following grounds. What is the allowable for income tax computation is not an expense. But for our case, Lamai, it is in our Inland Revenue Act, it is only expense. The expense should be incurred to the production of income. Fraud is not incurred for the production of income. Check the expense incidental to the business. No, it's not incidental to the business. The loss represent working capital and not fixed capital, and therefore not the capital expenditure. Anywhere this satisfied in any case, this is not, fraud is not incidental to the business. Therefore, it shall not be deductible. Apply case law provision to given scenario and provide the conclusion accordingly. Now, all the possible issues, analyze, Lamai, I need to come for the commonly what can be in your unseen, the tax perspectives, income tax adjustments in income statement is specific to the pre-seen. Based on the specific pre-seen information, what are the adjustment can be in your P&L income statement. Litigation expense due to non-maintaining required quality of the product. It has given. Page 2 of the pre-seen, need to analyze the information given in unseen. If it is incurred due to production of income, it's allowable. If not, it does disallow. Apply section 11 for the litigation expenditure. Exchange gain loss. Why we have exchange gain loss? We are doing the export. Then we have the foreign debtors. Due to export income, there are foreign debtors, realized gain. This is at the point of they are paying us, then it's at the spot rate. It's a realized, then therefore it is, if there is a gain, it should be part of the business income. If it is loss, it should be deductible. The unrealized gains disallow. Any scenario, in any circumstances, the unrealized gains should be disallowed. And for that, what we are applying section 11. Legal expenditure and penalty with reference to staff-related issues. Now, we have hired our staff from 2 manpower agencies. There are the issues with that manpower agencies, and to our HR manager, that employees has complained. Therefore, any staff-related issue, again, the legal expenditure or the penalties, then you need to look at what is the expenditure. Penalties under section 10, under disallowable expenses, it should be disallowed. And the legal expenditure, again, you need to analyze what is the nature and you need to take a decision. And after that, the registration fee for ISO and the HACAP, which is allowable deduction under section 11, because they are going to register for this due to increase their quality. It has given. Then in the page 3 of the pre-seen, then therefore, this is allowable deduction if it is there. Then penalties or litigation expenses due to issues relating to waste disposal from Central Environmental Authority. Apply the section 11 and section 10 subsection 1b. This is waste disposal. There are issues with the CEA, the Central Environmental Authority. Then obviously it's a government organization. If there are penalty disallowed, litigation, you need to analyze what's the purpose of the litigation. Section 11, again, you have to apply. CSR expenses. Now, looking at the actual scenario of the company, they are very keen about the CSR activities. Then if there are CSR activities done by them, when computing business income, disallow that. But you need to analyze the application of the qualifying payment under section 52 and the 5th schedule. Then after that, you need to go for that one. Then company does not has proper branding, recognition of the intellectual property rights. There may be unrecognized intangible assets. And check the accounting treatment on those. Anyway, impairment shall be disallowed and capital allowances shall be provided if depreciable asset under the definition of section 195. Then these can be in your unseen. Again, the interest income from loans to outgrowers. Now I have mentioned that paragraph while in my discussion. The page 5 of the pre-seen, it has given the CAPL has also appointed many outgrowers and supported them through a loan scheme. Now, loan should be provided by the CAPL to them. Maybe with the guaranteed by them, maybe with the financial institution. That the information not provided. But in the pre-seen, it has given CAPL has given particular, it's supported them to a loan scheme. Who is the person providing loan? Not given, but we can assume that it's from the CAPL. If it is Solamine, the CAPL finance income may have the loan interest income, because even the loan shall be provided at a concessionary rate. Then we are in the manufacturing and selling company, and we are not a person who is given the microfinancing. Then this seems to be investment income if it is in your P&L, but you need to look at the purpose and all, whether it's directly relevant to the business or whether this is investment income. Come to here. As per the information provided in the unseen, please check whether it is directly relevant to the business or not. As information of the pre-seen, not directly relevant to the business. If so, remove when computing the business income and identify under investment income under interest income. If the loan has given by CAPL, if interest not charged to them, then there is a transfer pricing issue. Loan has given by CAPL, but even at the concessionary rate, the loan, there should be interest should be charged. If not, there is a transfer pricing issue. Okay, then these angles you need to look at. Then ninth one, plan to purchase software to automate the process. Then therefore, it's in the page 5 of the pre-seen. Again, we need to look at recognition criteria. If it is intangible asset, apply class 5, type for the provide capital allowances, or if it has recognized under compute and software, provide capital allowances under class 1 asset category. Then intangible asset, if the actual useful lifetime has given, you have to apply the actual useful lifetime. If not, you have to go with how many years given in that, 20 years. Okay. Then it is based on the application, how it has recognized according to the accounting standard you need to look at. The recognition of expenses shall be checked clearly, since the CFO is in the concern of company not adhere to the LFRS's LKS. Therefore, again, you need to think this one because it has highlighted this directly impact to our tax computation. Okay, these are the 10 most specific adjustments which I can see based on the information of the pre-seen. Now come to tax perspective, other possible tax adjustment, which is the last discussion. Only I will take 10 minutes. Then, anyway, all of you all know, you have to start from the profit before tax. If no change in the unseen, it's a 369 million. It's in the income statement. Lamai, don't forget this time. All figures are in millions. Don't add the zeros for this. Be in a concentration manner, do the calculation. It's in millions. Then the next one, if my sounds and it's not clear, please let me know. Very close to the power cut also as an accessible charge. Second, transitional provisions, please apply. Property, plant and equipment, intangible asset, but other than the goodwill. Then capital work in progress, Lama, you can see in your pre-seen in the financial position, it has given the capital work in progress. Capital work in progress, which is 300, this is 300 million. Then this is not the depreciable asset, no capital allowances eligible. Amortization of intangible assets, disallow, capital allowances provide. If actual useful lifetime given, please I will share the screen for y'all. Let me come to where we were. Then, sorry. Okay, sorry. Okay, I think it's clear now. Here, I will in the amortization of intangible asset, it has explained. Then we have the other financial assets, which is investment in shares and investment in treasury bills. Then it has given in the pre-scene, we have invested in shares and invested in treasury bills, which is dividend income and interest income shall be recognized under investment income and remove it from the profit before tax. Don't forget interest income and the investment income subject to exemptions. It shall be taxed at 24%. Dividend income subject to exemption. It shall be taxed at the 14%. Okay. That part explained. Then I need to come for the rest of the adjustment, which is there may be disposal of listed shares. Accounting gain shall be removed from the business income. Gain shall be computed under investment income and it is exempted under third schedule. Accounting profit on disposal of the property, plant and equipment, remove it from the PBT. Accounting loss on disposal of PPE, add to property, plant, the profit before tax. It's a definite adjustment. In the pre-scene, it has given due to the research center implementation, they have removed the obsolete depreciable assets. Then this adjustment should be there. Then accounting depreciation of PP&E and amortization of intangible asset disallowed. Then next one, which is student forget to do, gratuity provision. All of y'all disallowing the gratuity provision, yes, but y'all not computing the, most of the student doing, y'all forget to compute the payment of the gratuity. Please do that. The gratuity provision should be disallowed under section 10 subsection 2 Roman 8 and payment is allowable deduction. Compute the payment of gratuity, take in the information provided in the pre-scene as well as the unseen board. In the pre-scene, Lama, you can see in the pre-scene, in the financial position, it has given the opening RBO, it's a 132 million and the closing 145. And in the income statement under OCI, it has given actuarial, where actuarial gain loss on the retirement benefit 0.12, which is in the 2022, which is unaudited. Then that information there, then therefore payment, we need to compute. Provision not given, obviously provision is given in your unseen, and based on all this information, you need to compute the payment. Therefore, remember and do this anyway, okay? When you are disallowing the gratuity provision, in that second, think that, yes, I have to compute the payment of gratuity, do it quickly. And the next one, inventory write-off, it is allowable deduction. There are drugs, there are medicine. Maybe there are write-off of inventory. It's a section 11 should be applied. Any provision should be disallowed. Impairment of trade debtors, it should be disallowed. Fair value gains and losses of financial asset, if charged to income statement, any unrealized gain should not be taxed. Realized gains, only the realized gain tax. More or less for financial instruments, there are unrealized gains and losses. If there is unrealized gain, remove from the PBT. If there is a loss, it should be disallowed. Finance cost, I don't know how many times I have repeated this. Finance cost, check the application of section 12 only for the year of assessment 21-22. Then apply the suspension of the finance cost. Do not apply section 18 for year of assessment 21-22. Then the last one, before the last, income tax case law, please go through all the income tax case law. And again, the plant case laws, please go through, because we have 2 factories. Then please go through all the case law. These are not only the 4 case laws, these are the headings of the 4 case laws. Therefore, please go through this all 4 types of the case law, including all the sub case laws. I don't know what can be tested. Okay. Then the next one, which is the tax perspective, other possible adjustment. We have other operating income and expense. It may be in dividend income, disposal of the PP&E, profit or loss, foreign exchange gain or loss, it is there. Then that particular adjustment I have discussed. Now come to the value added. That is the last 2 slides. Come to the value added tax. Lamai, this is the thing that in our product portfolio, some products are exempted from the value added tax according to the part 2 of the first schedule, para A, which is import or supply. But we are in the supply. We are doing the supply. In that, there are exempted supplies. Pharmaceutical products, yes, we are doing. Drugs, other than cosmetics, yes, we are doing. Raw materials for the production or manufacture of such products, we don't know that raw materials are we selling or not, but I have included it. Ayurvedic preparations other than cosmetic, yes, we have. Unani, Siddha or homeopathy preparation, we don't know, but included. Raw materials for such preparation, which the recommendation of the Commissioner of Ayurveda, but this one also we don't know, but maybe. Then, is it only knowing of the exemptions? No, I need to come for this one. What's the privilege of knowing exemptions? The claiming of the input VAT. Only allowable input VAT you can claim when computing the value added tax. I'm not focusing on the computation. I'm focusing on the writing part. There may be the company has claimed all the input VAT, which is not correct, Lamai. There are exempted supplies. For that exempted supplies, you need to disallow the input VAT. Then I really need for you to go through December 2018, question 3 part B, and the June 2019, question 3 part B. Please go through in the same kind of the scenario has tested. The assessment has came for the VAT. Then they have claimed all input VAT. Then therefore it's a what's your opinion? It's better to go through, at least revisit the answer. Then the only thing which you need to know, the application of the section 22 subsection 6, which is talking about how to claim the input VAT for exempted supply. Can we claim input VAT? No, we cannot claim. Therefore, when the computing allowable input VAT, we need to disallow input VAT relevant to exempted supply. And refer to the time bar provision of the assessment with reference to value added tax section 33, which is 3 years from the end of the taxable period. These things I know you all know, then please go through these areas. Okay, then with this, let me wind up the pre-scene discussion, which is for July 2022 examination, which is CAPL. All the nitty-gritties which we can see in the pre-scene, I have analyzed with the possible answers and the answer formats. Okay, then let me finish off, but if you have any questions, please let me know. Now, taking 5 minutes, I will come to your concerns. Then let me stop sharing this. Let me stop sharing on these. Then, and after that, I will come to your the issues which you all have mentioned. Then should we tax interest income even though WHT is deducted? What is this asking? Should we tax interest income even though WHT deducted. Lamai, for the interest income, other than for non-resident person, for resident person, WHT has abolished with effective from 1st January 2020. Then for this one, currently for year of assessment 21-22, it's not applicable, but there is an advanced income tax, AIT, if there is an interest with the fixed amount you're receiving, then for that, y'all can advise to the bank or the financial institution to deduct the AIT. It's not the WHT, it's the advanced income tax. Then you can advise to the bank to deduct that, and it is not a final withholding payment, then it shall be taken as a tax credit. Yes, it is applicable. That means it is tax again, and you need to deduct the AIT deducted on interest income. Please, it is not the WHT. It is advanced income tax. It is not in a compulsory basis. Taxpayer should provide advice to the bank or financial institution to deduct that. Okay, I think I have given that the explanation. Okay. Do we need to consider amendment after 31st March 2022? For income tax, there is no amendments after 31st March 2022. According to the press conference had, the amendments will be implemented with effective from 1st October 2022. Therefore, no worries about that. Anyway, the amendments after 31st March 2022, no the application for your exam, don't think. Then with reference to value-added tax, Lamai, the one change has happened on 1st January 2022, which is the VAT on financial services. VAT rate it was 15% up to 31st December 2021, but it has changed to 18% with effective from 1st January 2022. Maybe in your VAT question, if it has tested, because our period is 1st April to 31st March 2022, normally VAT on FSC is applicable to the banks and financial institution and other specified persons. Then in that, normally their accounting period going on 1st Jan to 31st December. Then therefore, examiner may be test that period, or else in any case, if it goes to after that means January, February, March, then you need to take for the 9 months or in the daily basis for first 9 months, 15% on the value addition you have to apply. After that 3 months, the 18%. But if it has tested, and keep in mind, the daily basis is a good appropriation, then rather than going for the monthly basis, even practically we are applying the daily basis, not much concern on the monthly monthly basis 9 to 3, but it's a daily basis good, but it has tested. Normally financial institution is the 1st Jan to 31st December. Then the next that one explain, can we have the presentation? Of course, yes. The sound problem issued. Then should we tax interest income? I have explained. Madam, can you discuss on the management fee paid to overseas investors, how to tax them? It is a management fee. I will discuss with a non-resident that perspective. Now, if the management fee has received to overseas investors, I'm looking from the perspective of the overseas investor. Then overseas investor is a non-resident person and he has derived income in Sri Lanka. What's the income? Is a management fee. It may be a technical fee. I don't know what's the source. Source means what's the service category. Maybe technical fee, maybe any service fee. Under any service fee category, under section 73, source of payment, the management fee, it will be covered. Then with this one, and also for non-resident, I will explain. First thing, you need to identify whether this person is non-resident person or resident. Then it is non-resident person. Second one, we need to look at what is the source of payment. It's a service fee. Then third one, we need to look at, okay, if it is a service fee, is it taxed in Sri Lanka? Yes. For the service fee, we have to apply the first schedule, paragraph 10, which is the rate is 14%. But it's according to the domestic law. You need to look at if there is a double taxation treaty. Then according to the treaty, there are provisions for exclusions. The independent personal service is for individual. And if it is any other service fee, you need to look at the provisions of the double taxation treaty, and accordingly you have to apply. Then it is for the both side I have mentioned. With reference to resident company taxation, the management fee, if we have remit to, in any case, make a pre-scene but in the management fees, if it has paid to the overseas investor for any reason, then if the tax is, if the domestic law provision applicable, 14% shall be deducted. It's at the WST at the point of the remittance, we have to pay. Then it is after paying that, it should be remitted to the overseas investor or overseas person. Then VAT rate is for the 8% or 12, since the VAT rate change in effective from make a puduma dinayatme. First 0/2022. Type higher. It is effective from 1st June 2022. What is your year of assessment? 1st April 2021 to 31st March 2022. Then the June is after that or before that is after that. 12% is not testing. Your last taxable period is testable is 31st quarter ended 31st March 2022. Or as the month ended 31st March 2022. At that time, we have applied the 8%, not the 12. Okay. Then, okay, after that, you have mentioned the 6. Sorry. Miss, can you share this presentation? Of course, yes. When will the record and upload to YouTube? They will do it immediately. Madam, can you please explain about the amendments of final withholding payment under section 7, under section 88. Now it says section 88, subsection 1A. Then it's only we have 2 final. It's for the local. We have only 1 final withholding payment, which is rewards betting. Rewards lotteries. For that, which is it's a final that 14%. Then for non-resident person. For any non-resident person, income derived in Sri Lanka, which WST deducted, but other than if it is received from the permanent establishment, then all final withholding. In earlier, we had interest 5%. Earlier mean prior to 1st January 2020. We had interest, we had dividend. Now that to abolish, removed, only we have the lottery rewards, that part 14%, it is final. And with reference to non-resident person, any WST deducted on the source of payment, if it is not derived through the permanent establishment, it is final. If it has derived through the permanent establishment, it is non-final. Then, Madam, any idea on which DTA agreement can be testable in this examination? How can I know? I don't know. Anyway, whatever DTA tested, what you all worrying, the relevant annexures are given in your paper. Only thing what you have to do, even if you know the testable DTA, are you going to read and by heart on that? No. Then the thing is, whatever the DTA given, you have to read that annexures and apply. Without reading, even for me, I cannot apply. Then in that, read that 2 or 3, maximum 2 annexures, read it and apply. Actually, I don't know what's the treaty which going to test in your examination. I think no more questions. Then can we wind up the session? Then this will be uploaded. I will share the presentation. Then don't worry, this will be shared. Then from my all the good thoughts, I am wishing you all the very best for your upcoming examination to whatever all the subjects you are doing. Then wish you all the very best for you all, and don't be panic in the examination. Read the requirement carefully. The time management is the essential factor. It's a 3 hours and 15 minutes. And please, whatever these 3 weeks, plan for your exam. Go through 100% of the syllabus. Don't go for the selective learning. It's not good for y'all. It's not give any advantage to y'all mind. Secondly, please go through all 4 past papers. Do that. Patrice time and do it. It's one of the critical success factor for you to pass the examination. And again, the next thing is study text, supplementary to study text. Please go through very validly the short form it has given. It's a very good for the students. Please go through by referring to all. I'm pretty sure all of you all can pass this. The main thing, you may be very much knowledgeable, you may be very much intelligent, but if you have not managed the time 3 hours and 15 minutes in the examination, it's really critical for you to pass, because no selections, you have to do all the questions, and 15 minutes for you to plan the answer. Since it's compulsory, when you receive the paper, whatever the question, take it, read the requirement, plan the answer. You have your answer formats. When you're receiving the answer booklet, you should need to start your answer. Don't waste that 15 minutes. It's critical for you to pass. Okay? Then with all, I'm again wishing you all the very best for your examination. Thank you very much for having, and thank you very much for being in the presentation.